Thank you, Fred and Mara, for the first of many amazing announcements here at Bitcoin 2026. Now, he sees it like he sees it, and usually he sees it before the rest of us do. Co-founder of BitMEX and founder of Maelstrom, please put your hands together and give it up for Arthur Hayes.
All right. Good fucking morning, everybody. I hope everyone is kind of sober after a weekend in Vegas. So I finished ski season, bit of a lull before heading to the beach for another 3 months. And I thought, well, I need to have a mental update on what I think on the markets. And so I just recently watched the 28 Days Later recent zombie movie, and that kind of was the inspiration for the title, and you'll see what I mean in a second. And basically, I had to think for a few days on how I think money printing is going to evolve and take into account what's going on in AI, what's going on in Iran with the war, and outcrops is this presentation. Obviously, I've turned a bit more bullish, and I'll explain why over the next 15 minutes. So, obviously, we can't ignore that there is a war going on right now. So I have to make a few assumptions in this presentation before I get to my eventual thesis. Number one, I hope that we're all not going to die in a nuclear holocaust. If we do, it's not investable, so it doesn't fucking matter anyways. So let's put that particular worry to the side. And number two, that the markets are going to look through this event as something short-term-ish, whatever that means, and it's time to think about money creation and money printing and what that means for Bitcoin. So every morning I get up, and if I want to dissect what's actually happening, at least for my portfolio in reference to the war, I just pull up this chart on Bloomberg that I created, and it's the 6-month futures contract on WTI oil minus the front month. And I'm really interested in the spread and the evolution. And so all I care about is, are there enough commodities and oil flowing through the strait, irrespective of the propaganda that I read from Donald Trump or from the Iranian side on what's actually going on in the strait? I just look at the prices. And as we see, it's kind of improved, meaning that front-end prices are tending towards the back end, which says that, yeah, shit's fucked up, but it's not like super duper fucked up, so I can ignore it and continue on thinking about other things. So whenever I get on stage, I'm always talking about money printing. And the evolution of my thinking from the last essay that I published about a few or 4 weeks ago is that on a medium-term basis, that liquidity is going to turn positive. And so if we think about on the negative side of the things, there's the AI deflation. And people have been talking about all of the knowledge workers who have or will lose their jobs because of very efficient and cheap models that can do knowledge work. I wrote an essay a few months ago about my expectation about what these losses could be. I'll put some charts up in a second, but that's on the negative side. I think that could be sort of a multi-$100 billion issue for the banking system. On the Fed side, I'll get into this in a bit, there's a lot of consternation in the markets about the Fed chairperson to be Kevin Warsh and whether or not he is a hawk or a dove. And I'm going to put his comments into perspective and basically say that they're neutral. They're neither good nor bad for liquidity. And the market, the people who are getting all freaked out about Warsh as a super hawkish Fed chairperson are not really into the tea leaves as they should be. And then finally, commercial bank lending. Why it's going to increase. Why the war economy in the United States and abroad is going to drive banks to issue more loans to people who are involved in the production of all sorts of armaments and the things that go into making those weapons. And finally, the banking regulation changes that will allow banks to increase the leverage on their balance sheets. So this is a chart that I've been looking at since October of last year. And the magenta line is the NASDAQ. Gold is the Bitcoin price, and white is the US Tech SaaS stock ETF. Now, most people believe, at least institutional investors, that Bitcoin is high beta NASDAQ. And it has behaved that way pretty much over the past 4 or 5 years. But since October, all-time high in Bitcoin, 126,000, to the present, it's down about 50%, while the NASDAQ's been flat. So broad-based big tech is held up okay, but if you take a look at the type of tech stocks that have gotten clobbered, it's all of the SaaS companies. companies who produce a product that now an AI can do for $10 a month, that they were charging $10,000 a seat, or some ridiculous amount of money. These stocks got hammered. I think that it pointed to a credit deflationary event that was not being recognized by central banks, and they weren't printing enough money, and Bitcoin followed suit. And this is pre-war, so I ended this chart on February 28th. So, and this is another wish of mine, is I want to fire all of my human accountants and lawyers. I spend way too much money on this shit. I can't wait for Claude to take over. And that is going to have a very bad impact on anyone who has loans out to these folks who earn, very, very good salaries. And this is basically sort of my thought process on AI being the new subprime and what that could mean for the commercial banking system. And I think this narrative drove Bitcoin lower from October till the US-Iran war started in late February. But since the war has started, Bitcoin has outperformed. It's outperformed NASDAQ and Magenta and outperformed the SaaS stocks. And basically, I think that Bitcoin is now focusing on wartime inflation. What is going to change now that there is an explicit admission by the United States and a lot of other countries that they're on a wartime footing, their defense spending is inadequate, and they need to print more money to build more bombs? So that is, putting the AI to the side, moving on to the Fed. And so, when Kevin Warsh was nominated, I think it was in January of this year, everybody started freaking out because in his tenure from when he was a governor, I think during the financial crisis after 2008 until present, he's been very critical about the Fed's very large balance sheet. And he's gone on record saying that he believes that the Fed balance sheet is too large, that he's going to find a way to shrink it, and alongside that, he'll be able to lower interest rates. Now, if you read my essays, you know that I am a big proponent that the quantity of money is more important than its price. And so I care more about what he says about the balance sheet than where the short-term interest rates go. And so if the market believes that there's going to be less dollar liquidity floating around the system because of what Warsh will do at the Fed, then they'll be bearish on Bitcoin and other risk assets. This is what we've seen in sort of the media talking about sort of this hawkish Fed that's going to come into place after May when Warsh takes over. Now, I don't believe that's the case. I believe that essentially the Fed will swap reserves and treasuries and repos and put them on the commercial banking system. And they'll do that with the help of new regulations in terms of how banks are allowed to hold assets on their balance sheet and how much capital they have to have against those. And finally, what I think is the most important to understand what Warsh will or won't do at the Fed is that he has a very material binding constraint. And that is he needs to work alongside Scott Bessent at the Treasury to make sure that whatever he does with the Fed's balance sheet does not impair the ability for Bessent to go out and sell billions of dollars of bonds. So here is a very simple balance sheet. There's no numbers because I know that's a little bit complicated for some people. So on the asset side, treasuries, mortgage-backed securities, and repos. These are the things that help people finance the purchase of treasuries. On the liability side, there's bank reserves, the Treasury General Account, the checking account of the government, and currency in circulation. And essentially, from 2008 to the present, the Fed boosted its liabilities in the terms of bank reserves and bought assets from the banking system. That's treasuries, mortgage-backed securities, and repos. And when Warsh says that the balance sheet is too large, he's saying that the Fed owns too many of these debt securities, and he wants to be able to reduce that balance sheet. So again, he could sell bonds. That's very disruptive to the market. Or what I think and what has been hinted at is that he'll do a swap with the US banking system. Now, the bank balance sheet, commercial banking balance sheet, again, has Fed reserves as an asset, something like $3-ish trillion that they have on balance with the Fed. They have loans. On the funding side, deposits and shareholders' equity. And so for a certain size of balance sheet, you have to have a certain amount of equity against it, and that's sort of capital adequacy ratios. And so what needs to happen is that the Fed and the banks need to swap. The banks need to get rid of the reserves, have a lesser demand for reserves, and replace those reserves with treasuries and repos. And this is what is being pushed with the deregulation of the US commercial banking system. So whenever you think about or hear Bessent and any other monetary officials of the United States government talk about deregulation, what they mean is we want to allow the banking system to absorb all of this debt that we're creating and take it off of the balance sheet of the Fed. And again, the end state is that the US commercial banks take over the money creation baton from the Fed, and you have treasuries and repos on their balance sheet, and the liability side deposits into shareholders' equities. Now, the point of all this is that the net effect to dollar liquidity is neutral. There's nothing being sold, there's nothing being bought. It's just a swap. It's purely regulatory fiction in terms of who is allowed to hold what. But at the end of the day, Wars can get up and tell people that he has engineered a smaller Fed balance sheet. But in reality, for us as investors, all we care about is what is the net effect. The net effect is nothing. And furthermore, Warsh is not going to get into a fight with Besant. They had this photo with Jerome Powell's face before. We'll just replace it with Warsh. At the end of the day, we've issued $38 trillion of debt, and you need to fund the government. The Federal Reserve will do what it's asked to do, which is make sure that the market is orderly so that people can buy this debt. And looking at spending. So this is a chart of the fiscal year. It's October to September. And as we can see, deficits from the COVID period to the present, largest peacetime deficits in the United States history, and fiscal year 2026, slightly tracking as a larger deficit than 2025. Now, the point of all of this is that the US Treasury is not going to spend less money. Donald Trump is not talking about how he's going to reduce spending in a dramatic fashion. That Doge thing happened last year. It's all forgotten about. It's all about wartime spending. His new defense budget is something like 50% over the previous one at $1.5 trillion. That does not sound like a treasury or politicians who are coming together to reduce spending so that the Fed can reduce its balance sheet. So all this talk about the Fed shrinking its balance sheet makes no sense because the politicians and the treasury that funds them is continually increasing the amount of debt that's out there. Here's another graphic. Who is buying the debt? The foreigners are not buying as much debt as they used to. I excluded countries that are usually used for hedge fund balances for the basis trade. And what you can see here is that 25% ownership of foreigners has sort of flatlined while the amount of debt has gone up a lot, which basically means there needs to be a new price-insensitive buyer for all that debt, and that is the U.S. commercial banking system. Now, the banking system can increase the amount of debt because of new regulations that just went live on April 1st of this year called the Enhanced Supplemental Leverage Ratio, and basically allows banks to hold less reserves and other types of assets against the loans and other things it has on its balance sheet. And this means that large banks like JP Morgan and Citibank can onboard more treasury and repos in the market and take that rollover from the Fed. And for smaller banks, the engine of lending within the United States economy, they can increase the amount of construction and industrial loans that are out there. And S&P Global estimates that this ESLR balance sheet reduction will generate $1.3 trillion of new loans. Now, why will banks have demand for loans? One of the criticisms about this analysis from some of my other macro friends is that they claim the banking system is not creating enough loans, or there's not enough demand. Well, we have a great source of demand, that is the U.S. Department of War. They not only will put in equity into certain deals, they'll guarantee off-take production, and banks, seeing that companies have a guaranteed customer that is a government that can print money, they will lend to them. They'll also lend to the resource miners who are mining the critical resources that go into making bombs. And finally, all of the AI capex is now a national security concern. And so when a hyperscaler runs up against the ability not to finance their debt out of free cash flow and they go to the market, they will find willing large banks with a massive balance sheet to support that debt. So monitor construction industrial loans. You can get it, I think, on a weekly basis from the Fed. This is just a chart from Bloomberg. The credit must flow. The great thing about bank lending is it has a higher multiplier than central bank lending, at about 3 empirically, we've seen empirically. So that's about $4 trillion that's created, which means that it's larger than the amount of credit that could be destroyed by AI taking people's jobs, which is why I've turned more bullish on Bitcoin. And I've got a few seconds left. Again, my liquidity chart has bottomed back in November of last year, around the same time that Bitcoin did. I think we've had a bit of a chop, we've had a bit of a war. Now it's time to break out, and that's why I believe Bitcoin is going higher. I think my end of year price target is like 125,000, whatever, it doesn't fucking matter, I'm long anyways, but thank you very much, everyone.